Hey Bowtie Nation, Joseph Hogue here, and something we need to talk about. The 4% retirement does not work. Selling 4% of your portfolio every year in retirement just doesn't cut it and puts you on the slow road to going broke. On a 4% withdrawal, you need $900,000 stock portfolio just to pay $36,000 in bills. And if you don't make at least 4% return every year, you're going to have less income the next year. That's why in this video, I'm going to reveal a simple option strategy to get free money in retirement, a way to generate income without selling your stocks. First though, I've got to send that special shout out to all you out there in the nation. Thank you for spending a part of your day to be here. If you're not part of that community yet, just click that little red subscribe button. It's free and you'll never miss an episode. Now, it's said nothing in this world is free, but using the covered call strategy with a twist I'm going to detail later is about as close as you're going to get to that for a retirement income. I know a lot of you have heard about this strategy, selling call options against your stocks, but stick around because that twist is going to minimize a critical risk in those covered calls. Now, if you haven't heard about the covered call strategy, this is where you sell call options against the stocks you own. That means you collect a premium cash payment now while giving another investor the right to buy those shares from you at a certain price. Remember, call options give an investor the right to buy a stock for a certain price, that strike point, by a point in the future. And we see here call options for shares of Apple, and these give an investor the right to buy shares at any point until they expire January 2025. The two most important numbers here are one, the strike price. That's the price you can buy the shares for if you buy this call option. For example, if you buy that first call option with a strike of $175 a share, you can buy shares of Apple for $175 each until any point until January 2025. Of course, that would be a steal with the shares already trading for $191 each, but the premium, that's what you're going to pay to buy those options. Here you see just for the right to buy those shares for $175 each, you have to pay someone $41 for that option. Now, as the seller of those options, that is the cash we'll be collecting to fund our retirement expenses. So as someone that owns shares of Apple, if I sell someone the right to buy those shares from me with these call options, I collect that cash right now. I hold on to the shares and sell them only if that other investor decides to use the call option. And the great part about this is you see some of these have those strike prices above where Apple is trading at right now. If I sell an investor the right to buy the shares from me for $200 each, they are going to pay me a premium of $26 right now. If Apple doesn't reach that $200 a share by the time those options expire, the investor is just going to let it expire without doing anything. They wouldn't buy the shares from me for $200 if they can just buy it for less in the market. So I would keep that $26 a share they paid me premium, plus I'd keep the shares. And how this works in retirement is to save you from having to sell your stocks every year for income. You see that conventional wisdom tells you to sell 4% of your portfolio each year in retirement. If you have a $400,000 portfolio, then you sell 4% of that, or $16,000 worth of stock for your living expenses each year. Hardly enough to live on, but the same investing rule says selling more than 4% means you're going to run out of your money too early. But with this covered call strategy and the twist that I'm going to show you later, the money you collect on that call option is going to be fully funding your retirement expenses. You won't have to sell your stocks, and you're going to collect more than twice the amount you would have with that 4% rule. In fact, I'll show you how to find the call options you need to sell for fully funding your retirement. And this strategy works. Beyond the income advantage and the downside protection that I'll tell you about next, the strategy has beaten a simple buy and hold strategy in stocks. A 2012 study by Goldman Sachs reviewed 16 years of covered call trades, finding that the strategy beat the stock market index by 3.6% annually, along with that lowered risk in a stock portfolio. The study also found that while returns to the strategy were only slightly lower in those strong bull markets, the protection and income in a down market was enough to produce that higher long-term return. So the advantages to this kind of an income strategy that I'll detail later are not only that it tends to beat the market on returns, but also provides the income you need without selling stocks and downside protection. If stock prices fall, you've collected some cash on those stocks and have hedged your risk. As we say here in the nation though, it ain't all rainbows and unicorns. There are two risks to this income strategy, but I'm going to show you how to get around these in the plan. First is the risk of a big drop in the stock price or the market. For example, if you had a $400,000 portfolio with about 1,000 shares of that NASDAQ 100 ETF, that's the QQQ, at a price of about $396 each in December 2021, you might have sold the January 2024 call options at a $440 strike price. You would have collected about $37.71 a share, or almost $38,000 in income at that time. But because of that massive drop in stocks last year, you'd have a portfolio worth just over $373,000. And if you went to sell another set of those options for more income, you just wouldn't get as much. But this is where the bond portion of our strategy is going to be critical. And I'm going to show you exactly how to set that up next in our strategy. With just a small amount in bonds, you're not only going to earn a fixed interest income, but also protect yourself from a crash in stocks. If stock prices do fall, you'll be able to spend down your bonds for income, giving your stocks time to recover. Now, the other risk in the income strategy is that you won't participate in huge upside moves. You can see this in my position on Weight Watchers, ticker WW. The stock has surged 180% this year, which has meant that a big return on my shares, but I did sell the call options against some of those at a $10 strike price. I collected thousands of dollars in income when I sold those options, but have missed out on almost $9,000 in profits on the stock. Now I'm going to show you how to reduce this risk by selling options at a price high enough that we still profit from an increase in the shares, but there's just no way around this if the stock jumps fast. You just have to be okay with making a great income and a good return on your shares. Do I wish I had that extra $9,000? Well, yeah, of course, but I'm also happy with the $60,000 return on the shares plus the income I collected when the stock was in the doghouse. I'm going to detail that strategy, including the returns next, but first, check out this new offer from Weebull. Sign up with the link I'll leave in the description, and you're going to get up to 12 free shares of stock. It's the best sign-up bonus you'll find online and a solid app for investors. Now, I use the Weebull app for its stock simulator with great research. With the paper portfolio, I can test out my strategies and stocks before risking my own money. Even if you don't use the app, click through and get your free stocks. Try out the app, and if you don't like it, take your free stocks and run. You'll also get cash back for transferring from another platform and earn 5% on any cash in your account. Now, one thing you do need to understand about this strategy, and I'm going to lay that out next, is how this free income strategy is taxed, because it can mean a big difference in your retirement. Now, here's a chart to explain selling call options on stocks and how that's taxed, and I'm going to walk you through this because I know it can seem confusing. So if you buy back the options you sold before they expire, then that difference between what you collect and then what you paid is going to be a short-term gain or loss. Now, we're not going to do that with this strategy. Remember, you're just letting those options expire, collecting the income, and then letting the options run out, so you shouldn't be buying back your options. Just let them expire and then sell more options against the stock, or buy back the stock and sell more options for more income. Now, if the stock price goes above the option strike and the call buyer takes those shares from you, that's this third column here. If you held the stock for longer than a year, then you're going to pay those long-term capital gains rates, which are usually lower than your income tax rate. So that's what we're going to do here with our strategy. Here, the amount you collected in income would be added to your gain on the stock. And if you didn't catch that, I want to repeat it because it is huge for your retirement planning. By using this strategy and making sure that you are holding that stock and option for longer than a year, you're going to be able to pay a lower capital gains tax rates instead of your income rates on your income in retirement. Now, on the other hand, if the option expires worthless, so if the stock price doesn't rise above that option strike, if you keep the stock, then the money you collected on that option is going to be taxed on a short-term basis and added to your income for taxes. So here's how I would set up the strategy, and I'm going to walk you through this, but it is super simple to use. Each year, you're going to sell your call options against stocks or stock ETFs in your portfolio at a strike price that satisfies your income needs or is at least 10% above the current stock price. I'm going to show you how to plan this out on a spreadsheet and then on Yahoo Finance with shares of Apple as an example. So with this strategy, you'll first put 2 years worth of expenses. So let's say you've got $36,000 a year times 2, that's $72,000 in your treasury bills here. Those are currently paying 5.36% interest. You see this $72,000 right here. You can see that this gives you just over $3,800 a year in interest. You then take the rest of your retirement money, that $328,000 here, and invest that across stocks and exchange-traded funds. Now, I'm going to use a single stock portfolio in Apple as an example, but please, folks, please do not have all of your money in just one or even a few stocks. We've got lots of other videos here on the channel about how many stocks to buy, how to use that core satellite strategy in ETFs, and I'm going to link that in the description below. But so now you've got that rest of the money in stocks and ETFs, and if you need that $36,000 a year minus what you're going to get from those treasury bills, that $3,800, then it shows here you're going to need just over $32,000 a year from your stocks and bonds in this covered call strategy. That would mean selling almost 10% of your stocks if we were using that traditional retirement approach, which isn't going to happen. If you were to sell 10% of your stocks every single year, you'd quickly be broke in retirement. But what I'm going to show you is how to do this without selling any stocks at all. So I've put some of the information we'll need here in the chart, and I'm going to show you how to find this on Yahoo Finance. But shares of Apple right now are trading for about $192 as I put this video together. If you had that $328,000 in shares of Apple, you'd have approximately 1,703 shares. Now, since you can only sell call options against 100 share lots, so each 100 shares of Apple you own, you can sell one call option against that. We're going to round this down to 1,700 shares, so you'll be selling 17 options contracts. Now, to find the amount you need to collect per share, and that's going to tell us which strike price we need to use for this covered call option. But to do that, we take this $32,000 that we need in income, and we divide that by the 1,700 shares. So I've got that set up here. The 32,141 divided by the 1,700 shares means we need to collect about $18.91, about $19 per share to cover those retirement expenses. I've also added here this 10% out of the money strike. So this is the strike 10% higher than where shares are trading at right now. Now, it would be great if we could sell a call option above that. That would give us the 10%. That would give us the opportunity to grow our portfolio along with collecting the income. Grow our portfolio at least 10%. Even if those shares go higher and that stock gets called away from us. But we know we need about $19 a share to meet those income needs. So next, we're going to go to any investing platform. I'm going to use Yahoo Finance here because it's free and easy to use. And if we go to Apple and then go to options here in the menu, we can see this drop down of all the options expiration dates available. So we go here, the options expiration dates. And again, I like to use the January call options just so I don't have to set this up every single month. I can sell it once for the entire year's worth of income. It makes it a lot easier. Plus, you're going to collect more in that premium. And we can see across the top of the table, we see the strike price for each option and then the last price. That's the last premium paid on these options. And we can scroll down until we find that $19 per share we need. And we see here it's right between $210 and $215. If we were to sell call options at a $210 strike price, we'd get about $20.85. That's quite a bit more than what we need. If we sell the $215 strike price, we get about $18.60. Okay, that is just a little bit less than what we need. I would go ahead and sell the higher strike price. Sell $215. You'd get most of what you need, all about 40 cents, and you would participate more in the upside to those shares, right? So in this $210 example, those shares would get called away. We would only profit in shares of Apple up to $210. Here, we profit all the way up to $215. We get $18.60, which is almost exactly $19 of what we need for those income. We own the shares. We're going to profit all the way up to $215 a share, or about 11.6% higher from where the shares are right now. So if shares of Apple go beyond that $215 share price by option expiration, that investor is going to buy them away from us and give us the 215 times 1,700 shares. That's just over $365,000. So not only did we pay all our living expenses for that year, we also made $37,000 in profit. With that, we're going to be able to go back in the market, buy more shares of Apple or any stock we want, and just repeat the process. But here's the twist that is going to save you from that big downside risk in stocks. You want to have about 2 years worth of expenses in bonds or treasuries. You can hold something like the Vanguard Long-Term Bond Fund. That's the ticker BLV, which pays a 3.9% yield, but I prefer holding a 1-year treasury bond. You can buy these directly from the treasury with no fees, and they currently pay a 5.36% interest rate. What this is going to do, it's going to give you the opportunity, if stocks do fall, then you're going to have 3 years to be able to spend down that income from the options, plus selling down your bond portfolio. You won't have to sell call options on the stocks and can let the market recover before you go back into your call option strategy. Just as important though, in those years when stocks rise and your overall portfolio does climb, use some of that money to replenish your bond portfolio to that 2 years worth of expenses if you had to sell it down. So each year, if any of your stocks or stock ETFs get called away, reinvest that money back into the stocks and sell your new call options against it for income. If stock prices didn't reach that option strike price, then you're going to keep the stock and sell new options against it. Either way, you're generating income for retirement without having to sell your stocks. And we're using the covered call strategy to create that retirement income here, but there is another way to make gold for your golden years. Check out the video here for the fastest way to live off your dividends, how to build a portfolio so you can live off that income. Now we've got that covered call strategy, and I know a lot of you are asking, so why not just invest in some of those covered call ETFs like the QYLD or the JEPI? Essentially, these are doing the same thing. The NASDAQ Covered Call ETF, the QYLD, is going to hold stocks in the NASDAQ 100 index and sell call options against that each month to produce that 11.9% dividend yield. There are a few problems here, and why I recommend doing the covered call strategy yourself instead of with these funds. First is that many of these, especially the QYLD, tend to lose money and underperform just a simple buy and hold strategy for stocks. We've seen how that covered call strategy can beat stocks with a higher return, but here we see the QYLD fund in red versus the NASDAQ 100, the index of stocks in which it invests, and it's not even close. The fund has lost 20% over the last 2 years, underperforming the index by 16% over that time. Now, some of this is because to pay out that monthly income and at a high yield, the QYLD has to sell calls every month and very close to that current price of the stocks it holds. That means it's going to miss out on more of the upside return when stocks do rise quickly, but still eat all of the losses when stocks fall. If that weren't bad enough, dividends on these covered call ETFs are always taxed as income, so you don't get that chance to pay the lower rates like we talked about earlier. Here, you're also losing more than 0.5% to that expense ratio when you invest in these. It may not seem like much, paying 0.6% to hold the fund and have it all done for you, but why pay when this covered call strategy is so easy to do on your own? Anyone can use this strategy. It will produce that consistent income in retirement and without having to spend down your portfolio. Get your free stocks from Weebull with the link in the description below, or click on the video to the right for the absolute fastest way to live off your dividends, a strategy I guarantee will surprise you. Don't forget to join the Let's Talk Money community by tapping that subscribe button and clicking the bell notification.